So let's talk about financial management. But
King of the road, trailer full, sailor in.
so when you say financial management, every day people deal with various transactions involving money. So as a student like you, your financial activities may include receiving your allowance and budgeting it. Also borrowing money and buying some items from store. These daily activities, or what we call economic activities, can be associated with the concept of financial management. Managing your finances also helps you achieve your personal goals. Say, for instance, if you want to buy a new item or visit new places, contribute financial and socio-economic causes, or save up for an emergency fund, you need to plan your spending and also saving strategies. You may also need to find ways to earn or receiving some extra money. Similarly, business also need to manage their finances to achieve their business goals. Setting up a new and expanding into new markets and introducing new products like goods or maybe a service one. And it cannot be achieved successfully without careful financial planning. Well, in this lesson, we will learn the fundamental concept related to financial management. So let's talk about your financial goals. Observing healthy financial habits will contribute tremendously to your success and also prosperity in life. To secure your financial future, you need to establish and also maintain these practices early. So this can become a strong integrated into your character as a person. This habit begins with identifying your financial goals. You have to be clear with what you want to achieve so that you can figure out the strategies and also the activities that you need to do and also perform. Say, for instance, you may target savings for a particular amount of money within a time frame or cutting your expenses by certain percentage. In order for you to do this, you need to have a good financial understanding and also awareness. You may obtain this knowledge by consulting a financial advisor who can help you plan, allocate, and invest, and also monitor your money. In the same way, companies seek the advice of financial manager to manage and control their funds. Financial managers are instrumental in identifying and executing business strategies. Organization would rely on the expertise of financial manager to achieve their fiscal goals, just as how you can count on the advice of financial advisor and also to attain your personal financial goals. Let's talk about finance. Experts relate finance within the activities of acquiring, spending, and managing money, and also other financial assets by individuals, institutions, governments, and also businesses. Personal finance, for example, deals with savings, investing, and spending money depending on personal goals and desires. Public finance involve government taxations, budgeting, spending, and debt to provide service to the public. In businesses, finance deals with obtaining, managing, and using funds to achieve the company's goals of maximizing shareholders' value. Finance is a broad field that deals with activity in the financial system. It has three areas of study that acts with each other. The first one is the financial institution and market. The second one is investment. And lastly is the financial management. Financial institution and market, such as banks and insurance companies, and investing companies help facilitate the flow of funds between savers and borrowers, or what we call also investors. Meanwhile, financial management involves financial analysis and planning, as well as decision on investment, financing, and capital structure, and how asset management to achieve business goals. Therefore, when we say finance, it deals with the study on how components of financial system manage resources and formulate important and sound decision. Remember that finance is different from accounting, because when we say accounting, it is concerned with recording, preparing, periodic reports, analysis, and also dissemination of information about companies' assets, liabilities, and equities. Financial managers utilize this accounting information and the information obtained from the financial markets to decide how a business should manage its asset, liabilities, and equity. Financial management is one of the areas of study in finance. When we say financial management, it's the science of art managing money. Here is an effective and efficient application of management functions such as planning, organizing, leading, and controlling financial assets to achieve organizational goals. Setting up a business from the seed of an idea is not as simple as waiting for a plant to grow. Business starts up needs initial and continuous planning, complemented by constant effort towards growth. Plans such as offering a new product, increasing production, and expanding a new market have to be funded. But the what we call acquisition of funds should never be conducted in an anticipated manner. Financial management determines the amount of additional funds needed and the means to obtain it. On the other hand, it also decides on how, where, and when to invest should be excess funds. Sound financial management and decision required information from the analysis of a business financial position or balance sheet. It is financial environment or balance sheet. It is financial environment or situation in the financial system. When we say financial system, it is exists when people, business, and government interacts to facilitate and expedite the flow of funds or capital or financial capital between savers and borrowers, or what we call also investors, or from savings to investment. It consists of financial institution, financial markets, and financial instrument where the exchange of fund occurs. These transactions involve savings, spending, paying taxes, earning interest, receiving salary or wages, or also investing. The image are also in investing. When we say financial institution, a financial institution is a organization that direct the transfer of financial resources from its source to potential users. It plays a part of an intermediary managing the efficient flow of funds between savers and borrowers. Financial institutions are involved with deposit, finance, insurance, investment, pension, and risk management. They also be broadly categorized as either depository or non-depository institution. Commercial banks, investment banks, and credit unions are examples of depository institutions, whereas financial companies, insurance companies, brokerage firms, and pension funds may be classified as non-depository institutions. Financial markets. Financial markets pave the way for financial manager to acquire funds from various sources. The exchange of finance resources happen in financial markets, which can either be capital or money markets. When we say capital markets, it deals with long-term debts and corporate shares. This includes securities, which are traded through brokers and dealers, which may also not occur in an organized stock exchange. On the other hand, Money markets involve short-term debts, securities such as treasury bills, commercial papers, and negotiable instruments from the government and other financial institutions. Financial instrument referred to as any contract which produce a financial asset of a party while creating a financial liability or equity instrument of another. The agreement is contained in a real or virtual document which deal with money. Corporate bonds, checks, option contracts, and shares of stocks are example of financial
Now let's move
instruments.
on.
On to what we call shareholders wealth maximization. As I mentioned earlier, the overall goal of business finance is to maximize shareholders' value. The maximization of shareholders' wealth is considered more credible long-term goal than those concerned with other return or stability as a single objective since it counts for both risky and return simultaneously. Say for instance, the return expected from two businesses, say for example the business X and the business Y, are equal. However, business Y is considered more risky. In effect, rational investor will naturally value business X more highly than business Y. Wealth maximization also balances short-term and long-term benefits in a way that profit maximization cannot. The stakeholders have to be satisfied within their investment in the company because it motivates them to invest more. Wealth maximization is the idea of increasing the business value to increase the value of shares held by its stakeholders. The concept requires the management to constantly seek the highest possible return on investment funds which decreasingly associated risk of loss. This requires a comprehensive cash flow analysis connected with investment and consistent attention to the business strategies. Let's have a closer look on wealth maximization. Say, for example, if a business spends the funds to develop a valuable property, say expansion and investment coalition possibly recognized for future positive cash flow associated with the new property by venturing up the price of company shares. So this is a concrete example of wealth maximization. The principle of shareholders' wealth maximization should hold the objective of ensuring the maximum return to shareholders. This means financial management is maximizing the price of a firm's common stock. To obtain these objectives, managers should consider the risk and timing link with expected earnings per share to maximize the stock price. When we say profit maximization, unlike wealth maximization, it is a short-term goal. A company may maximize its short-term profits at the expense of its long-term profitability. To obtain this goal, the company may need to borrow money to increase sales or expand production's capacity. Remember, too much borrowing may result in bankruptcy. The management tend to delay significant repairs and maintenance to avoid expenses and to show better profits. Without providing necessary action, this concern may affect the efficiency of the production in long-term run. An excellent performing companies of efficient employees, if the employees feel safe and sound in their workplace, they will surely preserve the goal of a company. A satisfying work environment is likely to be perceived favorably by the investors. Unsatisfactory treatment of employee may also lead to a lack of commitment by the staff and frequent staff turnovers. This would be expected to lead to an unprofitable and uncertain future for the business. A common goal will be attained if all the employees and staffs of the company are considered in the same light. Corporate organizational structure. To maximize the wealth of the owner, financial manager needs to determine the appropriate asset for the business, how to acquire them, and how to use them to get the best possible financial return from their use. Hence, the financial manager needs to be familiarized with the flow of funds within the company. This task required a good understanding of the company corporate organizational structure. A common corporation is divided into various departments, each of which is responsible for different tasks. A corporation is definitely guided by the board of directors or what called BOD. The member of board of directors are elected by the shareholders. The board of directors represent the shareholders in overseeing the business. The following are some responsibilities of the board of directors. Number one, they set direction for the business and establish corporate policies. Number two, they also hired and terminate members of the top management, including the president. Number three, they also determine the compensation of the key executives. And last one is they review and disclose major business decisions. Let's talk about the president or chief executive officer or CEO. The employed management of a corporation is headed by the president and chief executive officer or also known as the CEO. The following are some responsibilities of a president and CEO. Number one, they carry out the strategy and policy of the board of directors. They provide leadership for management and employees. Number three, they set long-term operational direction. And number four, they takes accountability for all company's activities result in the board of directors. In some companies, the president and also the CEO are separated person and entities. In this case, CEO is the highest officer in the company and the president is the second in command. The CEO focuses on growing company's value and maximization its wealth, while the president works to ensure business operations go smoothly and other long-term goals such as profit maximizations are met. Let's move on to the other person in the company, the vice president for sales and marketing. The sales and marketing department is generally responsible for growing the revenue and client portfolio of the company. The vice president for sales and marketing who heads this department has the following responsibility. He or she generate campaign businesses and market development. He also provides strategic direction, promotion, and advertising. Also, develop a strategic sales plan based on the company goals that will promote sales growth and customer satisfaction. Also, one of his responsibility is to create collateral, materials, and management of market research. And the last one is he or she oversees the development in sales and marketing, including the activities of the team members. The vice president for production. So when we say production department, this is responsible for the creation of goods and services. The vice president for production heads this department. And these are the following responsibility of the vice president for production. Number one, she provides leadership and management to the production team and tracks the development of the products. She also oversees maintenance staff that is responsible for the equipment. She also plans, directs, and coordinates the development of the manufacturer of all products that met customers' demands. And lastly, she ensures that the company uses the most efficient, effective, and economically viable methods for the production of the company's product. When we say Vice President for Administration, this office conducts much of the human resource and general management activities. It is headed by the Vice President for Administration, who has the following responsibility. Number one, she ensures security and safety in the publication activities. He also coordinates with finance and sales and marketing department, provide property management, assist in recruiting, and last one is assist with payroll, employees training, and performance reviews. When we talk about the President for Finance, or what we call the Chief Financial Officer or the CFO, she or he supervises all phases of financial activities and responsible for planning, managing the company's financial resource. When we talk about his responsibilities, these are the list of his responsibility. He acquired funds throughout financing method, lead and formulate investing decision, plans and control funds for operating activities, and last one is formulate effective dividend policy. Under the CFO or Chief Financial Officers are several managers. The top level financial managers in many companies are also the treasurer and the controller. Both of these positions are supported by the number of financial specialists. When we say treasurer, he handles financial external matters and has responsibility for the management of the company's cash, investment, and other resources as well as relationship with investors and also creditors. When we say controller, it concerned with the internal matters such as being in charge of accounting and financial records of the organization and provide supports for executive and other managers in understanding the using of financial data and reports. The role of financial managers plays very crucial and challenging roles. Aside from monitoring the company's financial status, they are also tasked to analyze financial information prepared by the accountants and implement financial plans. The following are responsibility and roles of financial managers. The first one is financing decision. Financial manager determines when, where, and how company will acquire funds. These funds can be obtained in different ways. The two major methods are equity financing and the debt financing. When we say equity financing allows an owner interest in a company to investors. Corporate equity financing is done throughout the sales of stock. So in other words, the funds came from the company's owners themselves. It is referred to as equity financing. When a company borrows from the other organization to finance its activity, it is deemed debt financing. It uses borrowed money to obtain needs assets. Individual or institution providing debt financing are creditors who receive payment in the form of principal and interest. If the company borrows funds from other organization to finance its activity, it is deemed to be debt financing. The combination of equity and debt used by the company to finance its operation and growth is also known as company's capital structure. There is no type of capital structure prescribed for all companies. It is the responsibility of the financial manager to determine the right capital structure of the organizations. Investing decision. Investing decisions are made to obtain the asset needs for business operation. One of the most important roles for financial manager is to help the company make effective, profitable investment. Investment also involves short-term and long-term decision of using the fund from selling assets. Short-term investment decisions are related to everyday operation of the business. This is also called working capital decision because they are related to current asset and current liabilities such as cash, inventories, receivable, and etc. When we talk about long-term investment decision, These are related to the investment of funds for a long period, which is usually more than 1 year. It is also called capital budgeting decision. Operating decision. Operating decision involve the daily operation of the company. In relation to this, the financial managers needs to determine how financial working capital accounts like account receivables and also inventories, and to plan objectives and goals concerning routine tasks. The company has option on whether to finance working capital needs by long-term or by short-term sources. Dividend policies. A common goal of a business venture is to earn profit or to have a positive return. In the case of profitability, the financial managers decide how much should be distributed among the shareholders and how much should be retained for future contingencies. In accounting, you might have learned that dividends, which are the part of corporations' earning, are distributed to the investors. The factor affecting the dividend decision of a companies are the following: the earnings, the stability of dividends, the growth prospects, cash flow positions, and the preference of shareholders. It is the financial manager's responsibility to determine the best dividend policy which maximizes the market value of a firm. So let's keep in mind that when we say financial manager, it helps individuals, governments, and businesses achieve their goals. It involves finance, which is the activity of acquiring, spending, and managing money and other financial assets. Financial management is the effective and efficient management of assets, liabilities, and equities to achieve company's primary goal, the maximization of shareholders' wealth. To do this, financial manager consider the long-term result and the risk or uncertainty, the timing of returns, and also the stockholders' return. Financial managers also make decisions based on the information they obtain from the financial system. The financial system is a mix of institutions and mechanisms that expedite the flow of funds from saving to investment. The four important roles of the financial managers are financing, investing, operating, and the dividend policies.